gold mining sector has a market capitalization, according to this right up to the minute calculation of the values of the gold mining sector, $690 billion. That is the entirety of the sector, the whole of the gold mining sector. But if you compare it with the US stocks, now you see that most US stocks at the top of the pile are many times larger than the entirety of the gold mining sector. So, for example, down here, 14th position, we have Oracle. Oracle is $713 billion in size, bigger than the 690 billion of gold miners.
Monaco 64, home of alternative economics and contrarian views. Happy August 15th, Clive.
Well, thank you, Mario. Terrible day in history, isn't it? It's the day that the dollar ceased to have any value.
Yeah, I mean, President Nixon said it was going to stabilize the dollar, though, and we're going to look at that in a minute. So it's not because Putin and Trump are meeting today that we're saying happy August 15th. It's because of that fateful day. It was a Sunday, Clive, August 15th, 1971, and I'm going to play part of the announcement that Nixon made here, the important one for us. So let's start with Tricky Dicky, they used to call him.
The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what is this action, which is very technical, what does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar.
So, Clive, he said at the end, the effect of this action is it will stabilize the dollar. So I'm going to bring up a chart here of the dollar versus gold since August 15th, 1971. So it's stabilized at 99% lower.
Wow. So, Mario, I don't know if you noticed this. I mean, I've seen this a few times now, so I almost know the words by heart. But he said, as he said the words, your dollar will be worth just as much tomorrow as it was worth yesterday. He's shaking his head like that. Your dollar will be worth just as much tomorrow as it was worth yesterday.
Did he do that? I didn't notice that.
Absolutely no confidence at all in those words.
Let's have a look. So you've done a bit of body language analysis here.
Well, I don't know. I noticed that for the first time today. But
broad market condition to buy slightly less. If you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as
shaking his head.
Yeah, I noticed that. Wow. Clive, I also have a magazine here that was published on August 30th, 1971. And this was sent to me by an American viewer, follower of the channel, who lives in Japan. And this magazine was published in Asia for the U.S. forces that were and are still stationed there. So, I mean, it comes across as very positive. He's smiling, the new dollar, the recovery plan. I mean, this is a lesson for people nowadays, I think, with all the propaganda that's going on about how America is going to come back. And I'm not saying it won't come back, but I think it's going to take a bit longer. Yeah, it's a lesson in history to be a little bit skeptical of what any politician tells us, don't you think?
Yes, and I think the message also is you never know what kind of announcement might be made or might have to be made tomorrow because suddenly the world financial markets are in disarray. And, I don't think anybody saw that in America, apart from those who are the insiders, the inner circle. I don't think anybody in America saw that announcement coming. From one day to the next, the dollar around the world ceased to be convertible back into gold.
Yeah. Some people, I'm not sure if it was you, but someone told me that they think the reason they closed the gold window, well, the reason we're given is that the French and the British were trying to convert too much and they're running out of gold. But maybe they ran out of gold. Would that be possible?
Well, if they did, they're not telling us, are they? They say the vaults are full of, I don't know, is it, I forgot, 560 tons of gold. I think I'm the figure now. But obviously,
8,000,
the rumors are.
8,133 metric
Thank
tons.
you. The rumors are that those vaults are full of cobwebs. Now, I don't believe it. I believe the gold is really there, but there's that always that little niggling doubt that maybe they got rid of it. When I say got rid of it, maybe they had no choice because everyone was saying, "Give it to us." Back in
Yeah,
1917, 1968 through to 1971.
I guess I'll give them the benefit of the doubt because the US did have 22,000 tons, I think, right after the war in the 50s. So, yeah, it was being depleted. Maybe they were able to stop it at 8,000 and it's been there ever since. But I think one of the major problems and why they haven't done an audit is that they've had to close a lot of leases that they've lent out that gold many times. And I think it's one of the reasons the gold is coming back to the US, physical gold. And Clive, there was a tweet yesterday. I'm going to try to find it for you here from the Secretary of the Treasury. Where is it? And he was talking about, a topic you and I've been covering a little bit about gold devaluation, revaluation, excuse me. Let's see if I can find it. Oh yeah, here we go. I'm gonna share it in a second with you guys and Clive. This is what Besant, I think someone asked him that question, and he said, Besant on gold, doubt we're going to revalue it, Fox Business Network. And Jan Neuenhaus, who's a pretty decent analyst, gold market analyst, says, so they will. And the word doubt is interesting, isn't it? Because,
It doesn't say 100% certainty, but
yeah,
obviously, if you were going to do something like that, would you want to spook the market by giving them advance warning? I mean, the best thing the United States could do right now is to buy as much gold as it can lay its hands on, because that will mess up all the other countries who are trying to get out of the dollar. Countries around the world are saying, "Oh, I feel a bit nervous about dollar. I feel a bit nervous about treasuries," and as long as the gold price continues to make high after high after high, it slows them down. They say, "Oh, can't buy today because maybe I'm the
yeah,
biggest fool by buying at the highest price ever." So the best thing, if I was the United States, I would be there in COMEX buying up all the gold and pushing that gold price higher and higher. And every time I see any indication that a foreign nation is trying to convert their dollars into gold, I'd be saying, well, I've got to make them feel like idiots by pushing that gold price even higher. So it wouldn't surprise me if they're out there secretly accumulating gold. And obviously they'd have to do it secretly, because if it became public, then of course all hell would break loose.
yeah, I agree with you. And I think a lot of foreign nations are going to keep buying gold because they want to not be as dependent on the dollar. They might still have some dollar reserves, but I spoke about this yesterday. It looks like President Trump now could direct foreign countries, where to put their surplus dollars. That he could tell them to invest in U.S. Businesses. But the other thing, Clive, they could do to kind of get one leg up on foreigners and their efforts to buy gold is to like revalue the price. Even if they revalue it to 3,500, which is not that far away, that would put a rocket up the international market price, and they, as long as that Nixon suspension remains valid, foreigners won't be able to go to the treasury and say, I want my gold at 3,500. They'd have to go to the market and it would be at 4,000. So I think, revaluing kills basically two birds with one stone. Maybe they're waiting until they have a deal with the Chinese vis-a-vis trade, because I think now they have a deal with Korea, Japan, the EU, the UK, the biggest, you could argue economies in the world. So if they're able to get the Chinese to maybe come up with an agreement, then they can go ahead and revalue. Because if they revalue now, maybe the Chinese will say, well, all negotiations are off, because I don't think they would like that, even though I think the Chinese have a lot of gold.
Yeah. Well, I mean, if they do it, let's say they were to revalue to spot price, 3,500, 3,400, something like that, it would immediately put a floor under the gold price. And as you said, Mario, the gold price would trade significantly higher than whatever the floor was at. It would have to. It would make no sense that nobody would say, if gold's got a floor at 3,500, I can't lose. I can't lose. I can only win. Obviously, people are gonna buy it until it's a much higher price where you can lose.
Yeah, and you can't ever trust what politicians, even though Besant really isn't a politician, but he's in government, can't really trust what they say 100%. Just like you couldn't trust what Nixon said. And anyway, Clive, I noticed this morning I saw something pop up on my phone, like a headline from Bloomberg, my Bloomberg app, and it said FTSE makes new all-time highs. But at the same time, there's an article on Bloomberg saying how London is suffering, how unemployment in London is worse than any other place in the UK. Like, people are closing restaurants, pubs. So and then we know that the UK economy is anemic, the growth. We have a huge debt problem, fiscal problem. So it's weird, isn't it, that the stock market still goes up? In my opinion, well, I'll let you give your opinion why you think it is, and then I'll chime in.
Well, actually, it may seem weird that we have a slowing economy and the stock market's going up, but actually in the UK, this makes quite a lot of sense to me. The UK FTSE 100 is chock-a-block full of large services companies, like insurance companies, banks, and of course we've got quite a heavy weighting in pharmaceuticals, which are been down in the doldrums for many years, and they're starting to make a bit of a comeback now in that sector. But if we come back to the services company, these are desk-heavy areas. And desk-heavy areas, the companies which have large numbers of desk-bound employees, like the insurance companies and so forth, they're going to be downsizing their staff numbers little by little over the next few years. Even if you only downsize by 5%, that's a lot of extra money when it comes through to your bottom line. So profits are going to be going up, I think. Obviously, we've got to watch out, because I think the Chancellor will take a slice of those profits. But on the grounds that everyone should get a share of them, there should be more profits for the shareholders in these companies, and that does lead to higher share prices. So I quite understand because this England, it's not really a manufacturing economy. I mean, what does England make? Tell me, Mario, have you got any ideas? Do we make anything in the UK anymore?
Not really. I mean,
apart from coffees and sandwiches?
yeah, I mean, all service sector related. I mean, we do have like what's the company?
And there's BA,
BAE. Yeah,
yeah,
they
the
make
defense company.
yeah they make engines for jets and like arms, but not much. I mean, I heard something years ago that in the 1920s, England or the UK had over like a something like 100 motorcycle manufacturers. I mean, that's all gone out the window. We have the highest price for electricity in the UK, so that's not going to encourage companies to come here and manufacture. But I've got here the components of the FTSE 100, Clive, and you see the commodity companies as well are a big part of the FTSE. You see Glencore is like 3% of the FTSE, Anglo American, Rio Tinto, so BP. So I think that's part of it as well because commodities are doing well and precious metals. But I also think, Clive, it's telling us that the market sees or investors are not confident about the UK economy. That sounds a little bit weird, but they're not confident about the currency and the debt. There's so much talk now that the economy is collapsing, that the IMF is going to have to bail the UK out, and maybe the Bank of England is going to have to step in and print more. So it's almost like Brazil, Venezuela, and some other countries when they had a lot of inflation and stagflation. The economy wasn't doing well, but the stock markets were because investors needed to put their money on something real and not government bonds.
Yeah, I mean that's the whole point. I think people are running away from confidence in a financial instrument, i.e., the dollar, the pound, the yen, the euro, which where they see that the government is out of control when it comes to borrowing. And if you look at the UK, I haven't got the figures in front of me, but I can tell you the UK levels of debt continue to rise at unprecedented rates. And there comes a point where the interest rate burden becomes unsustainable. So something has to happen, and obviously the answer up until now has been raise the taxes, put a tax on foreigners, put a tax on this, put a tax on that. But you can only go so far because you get to the point where you tax people to such a point that they say, "Thanks very much, I'm not going to do business in the UK anymore. I'm out of here."
Yeah, so we're talking about the government borrowing and debt costs and stuff, interest payments. I've brought up the UK 30-year government bond or the gilt, 30-year gilt, and this
We're
here,
looking at the is this the yield you're looking at,
yeah,
Mario? Yeah, make it
this
bigger.
is this is like the trust quartile crisis. We spiked to like just above 5%. But notice how now we're at 5.5. And usually, Clive, when you get like a move up like this in a consolidation, this is like a pennant. It's usually going down the pennant in a consolidation, and then the market goes back up. But in this one, I think the yields are so bullish, which is a bad thing, of course, because when yields go up, the price of the gilts go down. And the government also has to borrow more to cover their debt and also borrow more to cover the interest payments. So the fact that you have a rising pennant is really worrying. And it looks like we're breaking out. Right now, it's still holding. And I think there's still probably the Bank of England is still heavily in there intervening in this market. But yeah, look out when this.
So, so yeah, what this shows us is the investors, natural investors in gilts, which would be pension plans and large funds, they're becoming more and more reluctant to buy at the previous yield, and they're basically saying, if you want us to absorb any more gilts, we need a higher yield. And when you couple that with reduced appetite for the institutions to buy the gilts and increased need from the government to borrow the money. So on the one hand, you've got increased supply, more borrowing needed by the government, and you've got reduced demand as the appetite goes down. And the more the government needs to borrow, the less the appetite becomes because people say they're borrowing too much. And so it's a sort of vicious circle here.
Well, and here I've got the 30-year U.S. 30-year T-bond future, and this is the price of the T-bond future. It's a future on the 30-year government bond in the U.S. So yeah, might confuse people a little bit because I use the yield for the gilts, but this chart is really good as well. And we had a bull market in government bonds, at least in the U.S., since 1981, and we broke this massive trend line back beginning of 2023. The bear market started, of course, Clive, when in 2020. Do you remember? I think it was March 2020 when everything imploded. There's huge volatility, as you can see here, in the prices. And I think the 10-year yield got down to 0.3. I'm not sure where we got in the 30-year, maybe 1%. But ever since then, it's collapsed. And it's held for the last few years. But to me, this consolidation here looks really bearish too, because usually if you have a consolidation here, the market would be going up like this, like a little flag. But it's actually can't even manage to go back up. So I think that's why Trump and Besant are so desperate for the Fed to cut rates. But I don't think it's going to help anyway. So what's your view on this?
Well, you know, we're seeing this 30-year bond in America almost half price, and that's not surprising because there was a time when people thought that getting 0.3% for the next 30 years was a good deal, and now they're looking for more like 4.5% for the next 30 years. So you take 4.5%, or let's say 4.3% minus the 0.3%, that means that they want an extra 4% a year for 30 years. So 4 times 30 years, they want an extra 120% over the next 30 years. So of course the bond price has got to be lower.
I think the 30-year right now, Clive, is 4, almost 5. But yeah, I think you're looking at the 10, but it doesn't matter.
Oh, sorry, yeah. So that would, sorry, was that the 10-year you had?
Yeah, I had the 30-year future, 30-year future.
Okay.
But let's just look at where the 30-year yield went in 2020. It was right here. So that, yeah, it was at 0.7. So I think, Clive, if you look again at where is it? Where's the other chart? At this chart, usually when you get a move like this in a consolidation, after the consolidation ends, 3 out of 4 times the market goes in the direction of the previous trend, which was down. So can you imagine, in the next year or two, if this T-bond future price gets to 70, or even here, which was I think 56 in the early 80s, that would mean I would probably yields approaching double digits, 8% at least. I mean, that would probably mark a huge, a collapse of the dollar and every other fiat currency.
I mean, I remember back in the early 80s, maybe late 70s, you could get very high yields in Great Britain on the gilts. I can't remember how much I was getting, but I think it might at one point have been as high as 17% on some of the longer dated gilts back then. Very sadly, I didn't retain them they'd all expired by now. But I remember I was in the office, and one of my colleagues, who was a senior manager, I was a young lad, he said to me, "Clive, look at these yields." And he was showing me the gilts, and I can't remember the figures, but let's say it was somewhere in the range of 13 to 17%. He said, "You're never going to see these yields again."
Mm.
He said, fill your boots. And I went down to the post office. That was the way you bought gilts back then. I went down to the post office and filled in a lot of forms to buy a whole bunch of gilts with very high yields.
Yeah, I mean, he was kind of right. I think you never see that again, but you might actually see them again in in the next 5, 10 years. But here's the 30-year bond yield. It only goes back to 1987, but even then it was almost at 10. So yeah, I remember when I started in the markets, yeah, yields are 8, 8.5. That was normal. So when people say, "Oh, that's impossible," they haven't been around long enough where they don't look at technicals and history.
Yeah, I mean, you probably remember what happened around, I don't think they called it Black Monday, but that day that Britain dropped out of the ERM, they raised the interest rate twice in one day. I can't remember the figures, but I think
Yeah,
the first time it was to 12, and then it was to 15%.
yeah, I think the rate was at 10. They raised it to 12 and then 15, and then they dropped it back to 10 before the end of the day. It was crazy. So
Yeah,
they
but
because
as they dropped it back to 10, the pound collapsed 20 or 30% against the
yeah,
dollar
yeah, and
and
the
the euro. Well,
and
it
the
wasn't the euro,
Swiss
against the
franc.
Deutschmark.
In the Swiss franc, because I remember well, Clive, I just moved to London and I started working the beginning of September, and I negotiated my salary so I could make what I was making in Switzerland, and we used an exchange rate of 2.8. So after this crisis, I think it went down to 2.4. So I lost, yeah, my salary wasn't worth as much as it was. And that's one of the reasons I started looking, one of the reasons I started looking more into currencies and things like that. And also Japan, Clive, I'm hearing that there's a move to get rid of the prime minister. And I saw his name is, what's his name?
Shinsei something or other?
No, not the prime minister, but this guy I interviewed from Japan. I think is Norman or Nakamura. Is a young analyst. He's worked in the markets, and he thinks, yeah, he's seen as a clown, this prime minister. So they're trying to get rid of him. But Nakamura, the guy I interviewed, he thinks that this could be quite negative for JGBs, and this is the 30-year JGB. Clive, look,
Yeah.
how much it's moved, and also the fact that a few years ago, its yield was negative, which at the time everyone, well, actually didn't go. It went to negative, but it was very near zero, which was a really yeah, crazy thing. At the time, though, the reason why people were buying Clive bonds, even though the yields are near zero, is that, as you know, the long-term bonds, when their yields drop a lot, the price goes up. So it became a bit of a speculative bubble and not a place to get fixed income. But now that's all changing. People want the fixed income. And even Besant yesterday, Clive, he made a comment about the Japanese bond market. He said, "Oh, the Japanese need to get inflation under control because that could spill over into our market." And he even mentioned the 30-year Buxel, which is the German long-term bond. Their yields are going up. It almost seemed to me like he was trying to blame Japan and Germany for maybe the the incoming bond crisis in the U.S. and all around the world.
Well, you can rest assured that if there is a crisis, it won't be America's fault, according to the Mr. Trump or Bessent or anybody else
Oh,
who's involved
yeah,
with it. It'll be the foreigners' fault. It always is.
yeah, that's right. Clive, you wanted to talk a little bit about the miners and gold. You have a really interesting chart. Do you want to share
Yeah.
that with us?
Absolutely, Mario.
Or,
So,
yeah.
first of all, I've been studying the gold miners for the last few months, trying to. Well, it's more than a few months. I mean, it's been ongoing for a long time. Let me just find that what I want to share here. There we are, and share. The reason I've been studying this because, as we all know, the gold miners have been very depressed for decades. So, something like 15 to 20 years. We've seen the gold price inching up, but the gold miners doing nothing. The stock market's going up, and you could have been invested in just about anything, and you'd have made a lot more money than the gold miners, which were barely moving. In fact, they were pretty awful. But what's changed very, very recently, and I'm talking basically since the 1st of January this year, and we're looking at a chart here, is the gold miners have at last started to play catch up. So on this chart, you see the green shaded area with the white line on top. That's the gold price, which has risen by around, it's getting on for 26%. So it says 29%. 29% since the start of the year. And then you see the top four gold miners on the chart as well. Top four by market capitalization. Newmont Mining right at the top. It's up nearly 85%. Then we got Agnico Eagle Mines up 80%. Then I've got the GDX, which is the ETF, which measures the performance of all the gold miners, all the big companies. And then we've got Wheaton Precious Metals up about 75%, 70%. And we've got Barrick Gold, which is the letter B. It used to be called American Barrick, which was ABX, but now it's letter B for Barrick. That's up about 50 odd percent, 53% to be precise. So what we're seeing since the 1st of January is the start of the outperformance of gold miners. So that, you might be thinking, I've got such a good outperformance compared with gold, I should rush to sell the gold miners and buy something else. But if we look at it on the longer term, and here's a chart going back to 1968, before they had the revaluation of gold, and you see the gold price in the, again, it's the white line with the green shaded area. Now we see that gold is up 9,500% over that period since 68. And all the gold miners, the same companies you see way below, even the best of them is only up half as much over the period. So they're still massively underperforming. I'll just bring up, that's a little bit more recent. That's since the global financial crisis. It starts in 2006 and the crisis started in 2008. Again, you see all the gold mining stocks, with the exception of Wheaton Precious Metals, the black line at the top. But the shaded area, the green area with the white line at the top, that's the gold price. And underneath that, underperforming the gold price since 2006, that's nearly 20 odd years, we have the four largest gold mining companies and obviously the GDX, the gold mining's index, the ETF. So gold miners, even though they've had a very strong performance this year, I'll just bring back the chart this year, they are still massively undervalued relative to where they ought to be if they were keeping pace with the way the gold price has gone over the years. And when I've been checking these gold mining companies, I've found that across the board, they're mostly on relatively low price earnings ratios. I mean, all below 15 times, more or less, many of them below 10 times earnings. And certainly next year, many of them will be on price earnings ratios somewhere in the range of 5 to 10 times earnings based on the current gold price alone. And of course, if we have any rise in the gold price, it could be that much better, 27, 28 and beyond. But what I think is happening here, Mario,
Clive,
is that...
sorry, Clive, could you put back the chart from 1968?
Yes, here we are. That's the 1968 chart.
So no, go ahead. What you? I want to just look at that later. But what were you saying?
So what I think is happening is that a very tiny amount of the money in the technology sector is starting to move into the gold mining sector. And to illustrate that, I'm just going to bring up a little list here. I'll put that chart back for you in a second, Mario.
Yeah.
I just go, sorry, there we are. That's the gold mining. The gold mining sector, if you see it, I don't know if you can see that, probably it's too small. Let me see if yeah, but if
I've done it for you.
Okay. The gold mining sector has a market capitalization, according to this right up to the minute calculation of the values of the gold mining sector, $690 billion. That is the entirety of the sector, the whole of the gold mining sector. But if you compare it with the US stocks, now you see that most US stocks at the top of the pile are many times larger than the entirety of the gold mining sector. So, for example, down here, 14th position, we have Oracle. Oracle is $713 billion in size, bigger than the 690 billion of gold miners. We have JP Morgan, Walmart, Berkshire Hathaway, Tesla, Taiwan Semiconductor, Broadcom, Saudi Aramco, Meta, Amazon, and so on. All of these large American companies, each and every one of them is bigger than the entire US, not the global gold mining sector. So even a tiny little bit of money moving out of just one of these tech stocks into the gold sector, into the gold mining sector, could move the gold mining index a long way. And that's why I think that started to happen just this year. It's brand new, and it's a trickle of the money in the know, the smart money, which is starting to move away from the very overpriced technology stocks, saying, I better hedge a little bit and I'll have a little bit of this very undervalued gold mining sector. They're moving from stocks with price earnings ratios of 40, 50 times earnings, 35 times earnings, into stocks which are 5, 10, not more than 15 times earnings. So they're moving from a very overvalued sector into a very undervalued sector. And it's just a little trickle at the moment. But wait till we get nearer the end of the year and portfolio managers start to realize that they don't have any of the best performing sector in their portfolio, and they have to start thinking about window dressing, because their clients next year will be saying, what was the best performing sector last year? Oh, it was the gold mining index. Did you have any gold mining shares? Yeah, excuse. And they won't be able to use the excuse, it's so overvalued, I didn't buy it, because it's obviously so undervalued. So what excuse are they going to use? They won't have one. So those who are smart enough will be rapidly redeploying a little bit of their capital from those hot stocks into, as a kind of hedge, the gold mining sector. So when their clients say, what the hell were you doing last year when you missed the best performing sector of the market, they won't have to be sitting there making excuses. Oh, sorry, I thought it was overpriced, or no, it's been a dead duck for 50 years.
Yeah.
So let me put that chart back. You wanted to ask a question about that one.
Yeah, I was just wondering, oops, I've got it. I was just wondering, because it seems like gold is outperformed most of the time, these indices. And except for like wheat, is that wheat and precious metals there, the purple one, or Barrick?
So
Barrick did very,
so it's outperformed everything since
yeah,
1968.
yeah,
But if you take the very recent period here, since the
yeah,
1st of January this year, obviously the stocks are
yeah,
outperforming. And
yeah,
if we go back to the middle period, 2006, then wheat
yeah,
and precious metals was, out of the top 4 companies, was the only one to outperform
yeah.
gold.
It would be interesting as well to look at the junior miners if you could go back that far, because I think even though they're riskier, they'll probably even get even more outperform. They will outperform gold even more. And Clive, you were talking about money flowing from the big companies into the miners. The analogy that people have sometimes is trying to get the Niagara Falls to flow into a hose, isn't it? That's what it's going to be like.
Well, that's right, because as I said, the gold mining sector is one of the smallest sectors in the market, 690 billion, and that's the latest calculation. That's the highest calculation I could find. I saw some saying it's only 300 billion or 400 billion or 500, but maybe they're looking at a narrower market. Maybe they're only looking at the West markets, whereas I looked at the entire world. So 690 billion. If you put that in perspective, Microsoft is 4 trillion, 6 times as much.
I mean, yeah, you don't even have to go massively bullish the miners, but just like getting some exposure. If these big mutual funds, pension funds, hedge funds, like you said, they look at the performance and they say what did well. last year, and they say, "Oh, the miners, we don't have any." Even if they just put a little bit in there, it's going to be huge. Clive, before we wrap up, just wanted to ask you what you're thinking in terms of the Fed and rate cuts. Seeing that we saw some mixed data this week. Well, I mean, the CPI, they made a big deal out of it that it was a great number, but it was still near 3%, and the core was 3.1. And then yesterday, the PPI, which will flow into the CPI, was zero point 0.9 on the month. It rose instead of 0.2. So do you really, but it looks like they're going to start cutting. There's so much pressure on them.
Well, yeah, the day before yesterday, the certainty of a rate cut was 100%. The only question was, will it be 0.25% or 0.5%? Yesterday, after the producer price index came out, which was a shocking figure, I mean, it was 0.9% increase on the month, compared with an expectation of 0.3% on the month. Now, you can multiply 0.9% on the month by 12 if you want to find a possible annual figure, but which is very high. But what this shows is that the leading indicator for the CPI, which is the PPI, is starting to rise. The inflation of that is starting to rise very rapidly. So producers are already putting up their prices, maybe because of tariffs, probably because of tariffs, and that's going to feed through into the consumer price index over the next 3 or 4 months. There's always a lag between the producer price index going up and the consumer price index. So this huge leap in producer prices, the monthly, far more than anyone was expecting, is a signal that inflation is coming back. Now, unfortunately for Trump, he presumably cannot fire the new head of the Bureau of Labor Statistics because the previous one's gone, was fired by him for producing a bad labor number. So probably it's a bit too early to fire the new guy. I don't even know who it is, by the way.
Yeah, but I think the PPI it's not something they even talked about.
But yeah, let's talk about rate inflation.
Yeah, the markets focus on both, but the general public don't even probably know what PPI means.
Yeah, what's changed overnight? The probability of a rate cut has gone from not approximately, absolutely 100%, with the only question being 0.5% or 0.25%, now to the 0.5% cut going to 0% probability, and the probability of no change moving to about 8%.
So it still looks like they're going to cut by
Still
25.
likely, almost certain they'll cut at the moment, but only cut by 25%, 25 basis points, as opposed to the possible expectation that it might have been a 0.5% cut. We'll get a feeling for that in a few days. When's this Jackson Hole meeting? Towards the end of the month, I think. And then,
I forgot about Jackson.
Yeah, Jerome Powell will be speaking there and giving an indication in the market about the direction of travel. But of course, he's slowly but surely being outnumbered on the Federal Reserve Board. There's 7 people on the Federal Reserve Board, and we've now got 2 of them who are strong dissenters, calling for sharp rate cuts. We've got the new guy from just appointed by President Trump, replacing the lady who resigned unexpectedly 5 months before her term was up. I mean, she said she was going to concentrate on academia or something, but reading between the lines, she left in a huff, I suspect.
Stephen Mirren, and I think his term ends. This position is only until the end of January, and I noticed as well. What was I going to say? I think I forgot now. But Stephen Mirren. He's a proponent of a weak dollar. But I also saw that Bessent said recently that Trump even considered hiring Janet Yellen as the Fed chairman again, which I found quite interesting. But before we go, Clive, just want to share the chart of the Dow. And because the Dow hadn't made new highs yet, like the S&P and NASDAQ, but it's joining the party. And I think what this is telling us, despite the fact that You know, there are all the metrics are saying everything's overvalued, but people are not looking at the currency. Maybe, you know, the melt up or crack up boom is here, and this is telling us they're going to cut aggressively. Maybe not in September, but they're going to, you know, next year when they get a new chairman, it's going to be like cuts and QE. That's what I think we're getting here.
Well, you know, Mario, ever since you first invited me on your channel, we've been talking about the melt up, which is coming. And now I look back on it, I can see this melt up. It seems to have started in literally in everything about 5 years ago. You know, gold's at a record price, give or take, stock markets at a record price, and that's all around the world. Bitcoin's at a record price, house prices are at record levels. You know, everything is going north. People are, and if you look at the commodity sector, yes, there's some commodities which are down, like oil. But if you look at the commodity sector, you know, whether you're looking at cattle or lumber or all kinds of different types of commodities, you'll find that so many of these things are pretty much at record prices, and certainly a lot higher than they were 5 years ago. It tells me that even though we're not seeing all that much indication that the consumer price index, because consumer things are made by robots, in the arenas where there's a limited supply, people are trying to park their money in literally anything they can, and it's not money and it's not treasury bonds. They're trying to park it in tangible assets of various kinds. That's what's going on in the market, Mario.
Great.
It's a melt up. It's a melt up.
Yeah, I agree. And with that, I'm going to wish you a great weekend. And I'm assuming you'll be able to come on the live stream on Sunday. And want to wish the viewers as well a great weekend.
Can I just, Mario, make a quick plug for your viewers? For those who want to know which gold mining stocks I have bought, there's a video I brought out a few hours ago where I've listed 10 of the gold stocks. I've spent months studying these, and these are outstanding gold mining stocks, and two of them are really going to be absolutely fantastic. I've named them in my video. Go to my channel, Clive Thompson, and you'll be able to listen to the report. It's very detailed and gives you all the information about which ones I'm buying. It's not investment advice, but
Yeah.
you know, at least those people who want to study what I've studied, and I've got a lot of information there for you. You can find it all out on my channel, Clive Thompson.
I'll have a look at that too, Clive. Thank you. Bye.